The ability to handle money received and to control money paid is a fundamental requirement for personal and business success. Money has many functions and roles that it must fulfill. The functions of money are to act as a unit of account, a means of exchange, a store of value, and as legal tender. A unit of account means money provides a common measure to value goods and services. A means of exchange means money allows people to buy and sell goods and services without the need for bartering. A store of value means money can be saved and used in the future while maintaining its worth. Legal tender means money is officially recognized by the government as an acceptable form of payment for debts. The role of money is to enable trade, measure value, store wealth, and settle debts within an economy. The factors that affect and influence the role of money include personal attitudes, different life stages, cultural and religious beliefs, life events, external influences and trends, and interest rates. Risk is the chance of losing money or value, and attitudes towards risk affect the role of money, as cautious individuals may save more while risk-takers may invest for higher returns. Reward is the potential gain from financial decisions, and attitudes towards reward affect the role of money because people motivated by reward may seek higher risk opportunities for profit. Borrowing is obtaining money with the agreement to repay later, and attitudes towards borrowing affect the role of money because cautious individuals may avoid debt while others may use borrowing to finance major purchases or investments. Spending is using money to purchase goods and services, and attitudes towards spending affect the role of money because those who spend freely may have less available for saving or investing. Saving is setting money aside for future use, and attitudes towards saving affect the role of money because those who value security will prioritize building savings over spending. In childhood, financial needs are limited and depend on parents, so the role of money is to introduce basic financial understanding and the value of saving. In adolescence, individuals begin to manage small sums, learn budgeting, and develop spending habits, so the role of money grows in teaching responsibility and independence. In young adulthood, financial needs expand with education, housing, and work, so the role of money focuses on managing income, debt, and savings effectively. In middle age, individuals face responsibilities such as mortgages, family expenses, and retirement planning, so the role of money centers on stability and long-term investment. In old age, income often reduces while healthcare and living costs increase, so the role of money shifts towards maintaining financial security and comfort in retirement. Culture affects the role of money because religious and ethical beliefs influence how people view wealth, debt, spending, and charity. External influences and trends affect the role of money because factors like technology, inflation, or global markets shape how people earn, save, and spend. For example, technological advancements such as digital banking make money management faster and more accessible, while inflation reduces purchasing power and encourages saving or investing to preserve value. Interest rates are the percentage charged on borrowing or earned on saving over time. The costs of borrowing versus the reward of saving influence the role of money because high interest rates discourage borrowing but encourage saving, while low rates make borrowing cheaper and saving less attractive. There are many reasons why an individual would plan their expenditure. An individual would plan their personal finances to avoid getting into debt by budgeting and living within their means. They would control costs by monitoring spending and prioritizing essential expenses. They would avoid legal action and/or repossession by meeting debt repayments and managing bills on time. They would remain solvent by ensuring income exceeds expenditure. They would maintain a good credit rating by repaying loans and credit cards promptly. They would avoid bankruptcy by managing debt responsibly and seeking advice when facing financial difficulty. They would manage money to fund purchases by saving regularly and planning ahead. They would generate income and savings by investing wisely and setting aside part of their earnings. They would set financial targets and goals by identifying priorities such as buying a home or retiring comfortably. They would provide insurance against loss or illness by obtaining suitable cover to protect their finances. They would counter the effects of inflation by investing in assets that maintain or increase in value over time. The different ways to pay are cash, debit card, credit card, check, electronic transfer, direct debit, standing order, prepaid cards, mobile payment apps, contactless cards, charge cards, store cards, mobile banking, bankers' automated clearing services, faster payment service, and clearing house automated payment system. Cash is physical money used for instant transactions where the advantage is immediate payment with no fees, and the disadvantage is the risk of loss or theft. A debit card is linked directly to a bank account where the advantage is convenience and control over spending, and the disadvantage is that it requires sufficient funds in the account. A credit card allows borrowing up to a limit where the advantage is flexibility and potential rewards, and the disadvantage is interest charges if not repaid in full. A check is a written order to pay money from one account to another where the advantage is a secure record of payment, and the disadvantage is the delay before funds clear. An electronic transfer is a digital movement of money between accounts where the advantage is speed and convenience, and the disadvantage is that errors are difficult to reverse. A direct debit allows a company to collect regular payments from a customer's account where the advantage is automated bill payments, and the disadvantage is less control over the payment date and amount. A standing order is an instruction to make regular fixed payments where the advantage is consistency for recurring bills, and the disadvantage is the need for manual updates if payment details change. Prepaid cards are loaded with a set amount of money where the advantage is controlled spending and reduced risk of debt, and the disadvantage is potential fees and limited top-up options. Mobile payment apps allow payments using smartphones where the advantage is convenience and quick transactions, and the disadvantage is reliance on technology and internet access. Contactless cards enable tap-and-go payments where the advantage is speed and ease, and the disadvantage is spending limits and security risks if lost. Charge cards require full repayment each month where the advantage is interest-free use, and the disadvantage is high penalties for late payment. Store cards are offered by retailers for purchases in specific shops where the advantage is discounts or rewards, and the disadvantage is high interest rates if balances are not cleared. Mobile banking allows customers to manage finances through a smartphone app where the advantage is 24/7 access to banking services, and the disadvantage is vulnerability to cyber threats. Bankers' automated clearing services is a system for transferring funds electronically where the advantage is reliability for regular payments, and the disadvantage is that transactions take around 3 working days to clear. Faster payment service allows near-instant money transfers where the advantage is speed and convenience, and the disadvantage is that it may have lower transaction limits. Clearing House automated payment system is a same-day payment system for large transactions where the advantage is guaranteed same-day settlement, and the disadvantage is high transaction fees. The different types of current accounts are standard, packaged or premium, basic, and student accounts. A standard current account is the most common type of bank account where the features include a debit card, checkbook, overdraft facility, and online banking. The advantages of a standard current account are convenience, access to various banking services, and the ability to manage day-to-day finances easily, while the disadvantages are potential overdraft fees and limited additional benefits. A packaged or premium current account is a type of account that offers extra services for a monthly fee where the features include travel insurance, breakdown cover, and preferential interest rates. The advantages of a packaged or premium current account are access to added financial and lifestyle benefits, while the disadvantages are the monthly cost and the risk of paying for benefits not used. A basic current account is a simplified account for those with poor credit or low income where the features include a debit card and the ability to receive income and make payments but no overdraft facility. The advantages of a basic current account are that it provides access to banking for those unable to open standard accounts, while the disadvantages are limited features and no access to credit facilities. A student current account is designed for individuals in higher education where the features include interest-free overdrafts, discounts, and incentives for managing finances while studying. The advantages of a student current account are the ability to borrow interest-free and access student-specific rewards, while the disadvantages are that overdraft limits vary and must be repaid after graduation. There are many financial products that an individual can use, whether it be to borrow, save, or insure their property. The different types of borrowing are overdrafts, personal loans, hire purchase, mortgages, credit cards, and payday loans. An overdraft is a short-term borrowing facility linked to a current account where the features include a set limit, interest charges, and repayment flexibility. The advantages of an overdraft are quick access to funds and flexible repayments, while the disadvantages are high interest rates and potential fees if the limit is exceeded. An overdraft would be suitable for individuals needing temporary financial support, such as covering short-term cash flow issues or unexpected expenses. Personal loans are borrowed sums repaid over a fixed period where the features include fixed monthly payments, set interest rates, and a defined loan term. The advantages of personal loans are predictable repayments and access to larger sums, while the disadvantages are interest costs and the risk of debt if repayments are missed. Personal loans would be suitable for individuals planning large purchases or consolidating debts over time with stable income to meet repayments. A hire purchase is a type of credit agreement used to buy goods where the features include an initial deposit, regular installments, and ownership transferred after final payment. The advantages of hire purchase are spreading the cost of expensive items and eventual ownership, while the disadvantages are higher overall cost and risk of repossession if payments are missed. Hire purchase would be suitable for individuals wanting to buy vehicles or appliances without paying the full cost upfront but who can commit to regular payments. Mortgages are long-term loans used to purchase property where the features include fixed or variable interest rates, long repayment terms, and secured borrowing against the home. The advantages of a mortgage are the ability to own property and build equity, while the disadvantages are long-term debt and the risk of repossession if repayments are not made. A mortgage would be suitable for individuals with stable income who wish to buy a home and can afford regular long-term repayments. Credit cards are revolving credit facilities that allow spending up to a set limit where the features include flexible repayments, interest on unpaid balances, and potential rewards. The advantages of credit cards are convenience, purchase protection, and potential rewards, while the disadvantages are high interest rates and the risk of accumulating debt. A credit card would be suitable for individuals who manage spending responsibly and repay balances regularly to avoid interest. A payday loan is a short-term, high-interest loan intended to cover expenses until the next payday where the features include small loan amounts and rapid approval. The advantages of a payday loan are fast access to cash and minimal eligibility requirements, while the disadvantages are extremely high interest rates and risk of debt cycles. A payday loan would be suitable only for individuals needing urgent short-term funds and who are confident they can repay it quickly without financial strain. Saving is the act of setting aside money from income to use in the future rather than spending it immediately. Investment is the act of using money to buy assets or financial products with the aim of generating a return or profit over time. The different types of saving and investment are individual savings accounts, ISAs, deposit and savings accounts, premium bonds, bonds and gilts, shares, and pensions. Individual savings accounts are tax-efficient accounts where the features include a yearly deposit limit, tax-free interest or returns, and access to cash or investment options. The advantages of individual savings accounts are tax-free growth and flexible access to funds, while the disadvantages are deposit limits and potentially lower returns compared to riskier investments. An individual savings account would be suitable for individuals seeking safe, tax-free savings options with easy access to their money. Deposit and savings accounts are bank or building society accounts used to store money securely where the features include variable interest rates, instant or limited access, and deposit protection. The advantages of deposit and savings accounts are security, simplicity, and accessibility, while the disadvantages are low interest rates and limited growth potential. A deposit and savings account would be suitable for individuals who want a low-risk way to save and access money easily for short-term needs. Premium bonds are government-backed savings products where returns are paid through a monthly prize draw instead of interest where the features include no guaranteed return and tax-free winnings. The advantages of premium bonds are security and the chance of winning tax-free prizes, while the disadvantages are the lack of guaranteed income and inflation-reducing value over time. A premium bond would be suitable for individuals seeking a safe savings option with the possibility of occasional prize-based rewards rather than regular interest. Bonds and gilts are fixed-interest investments issued by companies or the government where the features include regular interest payments and repayment at maturity. The advantages of bonds and gilts are predictable income and lower risk compared to shares, while the disadvantages are lower returns and vulnerability to interest rate changes. Bonds and gilts would be suitable for individuals seeking steady, long-term income with lower risk exposure. Shares represent partial ownership in a company where the features include dividend payments and the potential for capital growth based on company performance. The advantages of shares are the potential for high returns and dividend income, while the disadvantages are the risk of loss if share prices fall and market volatility. Shares would be suitable for individuals willing to take higher risks for greater long-term rewards and who can manage fluctuations in value. Pensions are long-term savings plans designed to provide income in retirement where the features include tax relief on contributions, employer contributions, and restrictions on early access. The advantages of pensions are long-term growth, tax benefits, and financial security in retirement, while the disadvantages are limited access until retirement age and the risk of investment fluctuations. Pensions would be suitable for individuals planning for future financial stability and who are prepared to commit money for long-term retirement savings. The risks to saving are that inflation can reduce the value of money and that low interest rates may limit financial growth. The rewards to saving are safety, accessibility, and the gradual accumulation of funds for future use. Saving would be suitable for individuals who prefer low risk, want quick access to their money, or are planning for short-term financial goals. The risks to investment are potential loss of capital, fluctuating market values, and uncertainty in returns. The rewards to investment are the potential for higher profits, dividend income, and long-term capital growth. Investing would be suitable for individuals willing to take greater risks for higher returns, especially those focused on long-term financial goals such as retirement or wealth building. The different types of insurance products are car, home and contents, life assurance and insurance, travel, pet, and health insurance. Car insurance is a policy that provides financial protection against accidents, theft, and damage to a vehicle where the features include third-party liability cover and optional comprehensive protection. The different types of insurance policy for car insurance are third-party only, third-party fire and theft, and fully comprehensive cover. The advantages of car insurance are legal compliance, financial protection, and peace of mind, while the disadvantages are high premiums and possible excess payments. Car insurance would be suitable for all drivers, with comprehensive cover ideal for new or high-value cars and third-party cover suited to those driving older or less valuable vehicles. Home and contents insurance is a policy that protects buildings and personal belongings from risks such as fire, theft, or damage where the features include building cover, contents cover, and combined policies. The different types of insurance policy for home and contents insurance are buildings insurance, contents insurance, and combined buildings and contents insurance. The advantages of home and contents insurance are protection from financial loss and peace of mind, while the disadvantages are ongoing premium costs and exclusions in cover. Home and contents insurance would be suitable for homeowners and renters, with building cover necessary for property owners and contents cover beneficial for tenants and homeowners alike. Life assurance and insurance are financial products that provide a payout after death or after a set period where the features include fixed premiums, lump sum payments, and optional investment elements. The different types of insurance policy for life assurance and insurance are term life insurance, whole of life insurance, and endowment assurance. The advantages of life assurance and insurance are financial security for dependents and peace of mind, while the disadvantages are long-term costs and the risk of no return if the policy expires before death. Life assurance and insurance would be suitable for individuals with financial dependence or long-term commitments who want to provide for their family after death. Travel insurance is a policy that protects travelers against risks such as medical emergencies, cancellations, and lost luggage where the features include single-trip, annual, and specialist travel cover. The different types of insurance policy for travel insurance are single-trip policies, annual multi-trip policies, and long-stay or backpacker policies. The advantages of travel insurance are financial protection during trips and coverage for unexpected incidents, while the disadvantages are additional travel costs and exclusions for certain activities. Travel insurance would be suitable for individuals traveling domestically or abroad, with frequent travelers benefiting from annual policies and occasional travelers from single-trip cover. Pet insurance is a policy that helps cover the cost of veterinary treatment where the features include lifetime, time-limited, and accident-only options. The different types of insurance policy for pet insurance are lifetime cover, maximum benefit cover, time-limited cover, and accident-only cover. The advantages of pet insurance are financial assistance for vet bills and peace of mind, while the disadvantages are high premiums and exclusions for pre-existing conditions. Pet insurance would be suitable for pet owners who want to ensure they can afford medical treatment for their animals without financial stress. Health insurance is a policy that pays for private medical treatment where the features include hospital care, specialist consultations, and preventative services. The different types of insurance policy for health insurance are individual health insurance, family health insurance, and employer-provided group health insurance. The advantages of health insurance are faster access to medical care and choice of providers, while the disadvantages are high premiums and limited cover for some treatments. Health insurance would be suitable for individuals who prefer private healthcare or wish to avoid long NHS waiting times for treatment. Thank you for watching this video on understanding the importance of managing personal finance. I'll see you in the next one.